In a world where economic uncertainty looms large and inflation refuses to back down, silver is beginning to shine more brightly than it has in over a decade. Global investors, analysts, and market observers are all taking notice as silver climbs past $36 and $37 per ounce, levels unseen in the past 13 years. This steady ascent isn't just a random spike. It's a reflection of powerful, converging forces reshaping both the financial and industrial worlds. From surging demand in green technologies to mounting fiscal concerns and currency instability, silver has found itself at the center of a profound shift. In today's video, we dive deep into the reasons behind silver's rally, the implications of continued central bank gold purchases, and what experts like Clive Thompson foresee for the future. Make sure to subscribe and hit the bell icon so you never miss insights like these again. Silver's upward momentum is not merely a result of speculative trading, it's the product of a global transformation. Industrial demand is accelerating dramatically, especially from sectors like solar energy, electric vehicles, and high-efficiency electronics. Silver's unique physical properties, particularly its unmatched electrical conductivity, make it indispensable in these industries. As components shrink and efficiency becomes critical, silver's reliability becomes non-negotiable. This means even as products get smaller, the demand for silver increases. Simultaneously, investor interest in silver as a hedge against inflation and currency devaluation has surged. As the US dollar weakens, its appeal as the world's reserve currency diminishes, driving investors toward hard assets like silver and gold. Unlike gold, however, silver benefits from its dual role. It is both a store of value and a critical industrial input. This makes silver uniquely positioned in the current economic climate, functioning not only as a financial shield, but also as a building block of the future economy. According to Clive Thompson, a prominent voice in the commodities space, the silver supply deficit has widened consistently over the past several years. Mine production continues to fall, while industrial consumption relentlessly rises. This persistent imbalance between supply and demand has only one short-term solution: recycling. Whenever silver prices spike, recyclers tend to emerge, individuals liquidating old coins, bars, or even silverware. But there's often a lag between the price spike and the influx of recycled silver. That lag contributes to temporary supply squeezes, supporting higher prices. Clive believes that this structural deficit isn't going away anytime soon. In fact, it's likely to grow, driving silver prices even higher. He estimates that there's about a 30% silver could touch $40 in the coming weeks. The market has already shown remarkable strength, with prices surging past psychological resistance at $35 and pushing toward $37 and beyond. Once silver broke through the $35 resistance level, sentiment shifted dramatically. Traders and investors flooded the market, many believing this breakout signaled the beginning of a new bull run. Clive noted in a recent update that when silver hit 35 and 50, it rapidly climbed to 36, possibly within the same day. Futures markets have now priced silver as high as 37.10 cents, and although spot prices may slightly lag, the momentum remains strong. This price behavior reflects both fundamental strength and a psychological inflection point. For many market participants, $35 was the level they were watching. A line that once crossed suggested an entirely new range of price potential. The chart patterns, technical setups, and volume trends all indicate we may only be in the early stages of this rally. While gold remains a staple of central bank reserves and a proven safe haven asset, silver offers something gold cannot: industrial utility. Analysts at Bank of America have revised their forecasts, now expecting silver to outperform gold in 2025, with prices potentially reaching $40 by early 2026. The rationale is simple. Silver's dual role provides a stronger foundation for price appreciation. Yet gold isn't sitting still either. China continues its steady accumulation, adding around 60,000 troy ounces in May alone. This strategy is widely interpreted as a move to reduce reliance on the US dollar and elevate the global standing of the yuan. Other central banks are following suit, marking the fourth consecutive year of aggressive gold buying. These actions reflect a growing desire to diversify reserves and hedge against geopolitical and monetary risks. Something unusual has been happening in the gold futures market. Traditionally, institutions roll over contracts rather than take physical delivery. But since January, a significant shift has occurred. Traders are increasingly opting for delivery of 100-ounce bars, each worth over $330,000. This level of physical acquisition is unprecedented on the COMEX exchange. Why the sudden change? Theories abound. Some speculate that a major buyer, possibly a foreign government like Mexico or Canada, is quietly building reserves. Others even suggest the U.S. government could be preparing for a return to a gold-backed dollar. If such a shift were ever implemented, it would require a massive upward revaluation of gold, perhaps to $4,000 or even $35,000 per ounce, to support even a partial conversion of dollars to gold-backed equivalents. Clive Thompson also highlights another driver behind the precious metals rally: unsustainable national debt. The U.S. government continues to expand its deficit, recently projecting a fiscal shortfall of $2.6 trillion for the current year. Meanwhile, economic growth remains anemic, and the Congressional Budget Office forecasts a steep rise in the debt-to-GDP ratio over the next decade. This trajectory resembles a household whose income rises 1 to 2% annually, while credit card debt grows by 10% to 20%. Eventually, the imbalance becomes unsustainable. The CBO's assumptions are also problematic. They rely on interest rates remaining low, around 2.8 to 3.3%, even though current borrowing costs have already surpassed 4.4%. If interest rates stay elevated, the debt burden will worsen dramatically. Unlike Japan, which holds most of its debt domestically and enjoys near-zero interest rates, the U.S. has a large proportion of externally held debt and rising borrowing costs. This makes America more vulnerable to fiscal shocks and more likely to resort to monetary stimulus, aka money printing. If interest rates continue to rise, the Federal Reserve may be forced to intervene again, just as it did during the 2008 financial crisis and the COVID-19 pandemic. By printing money to purchase government bonds, the Fed can suppress yields and manage debt servicing costs. But this strategy has long-term consequences. Although official inflation metrics remained tame during prior rounds of quantitative easing, real-life costs, especially for retirees, skyrocketed. Healthcare, education, and housing all saw dramatic price increases, eroding purchasing power and harming those on fixed incomes. This stealth inflation undermines the credibility of CPI data and encourages investors to seek refuge in hard assets. Looking ahead, the green energy transition promises to be a major catalyst for silver demand. As nations strive to reduce carbon emissions and build renewable energy infrastructure, silver will be central to that mission. Solar panels, electric vehicle components, and advanced electronics all require silver in increasing quantities. This surge in industrial demand, coupled with constrained supply, tightens the market further. Unlike gold, silver is consumed in the production process and is often not economically viable to recover. This means that as demand spikes, available silver stocks dwindle, intensifying upward pressure on prices. Another reason silver is becoming increasingly attractive is the growing risk of a global currency reset. As countries seek to reduce their dependency on the dollar and explore alternatives like gold-backed currencies or central bank digital currencies, CBDCs, precious metals are likely to benefit. Investors view silver as a hedge not just against inflation, but against systemic change. If a reset does occur, whether through a formal revaluation or gradual policy shift, assets like silver could become foundational in a new financial system. Already, many governments and institutions are positioning themselves for this possibility by acquiring tangible stores of wealth. Silver is no longer the underdog of the metals market. With mine production falling, industrial use surging, and investor demand booming, it has emerged as a vital asset for the future. The current rally reflects not just market speculation, but structural realities. A world awash in debt, grappling with inflation, and pivoting toward new technologies and energy solutions. Whether it reaches $40 in the coming weeks or not, the long-term trajectory for silver appears decisively upward. So what do you think? Are we entering a new era for silver and gold? Could a global financial reset really be around the corner? Let us know your thoughts in the comments below. And if you found this breakdown informative, make sure to like the video, subscribe to our channel, and hit the bell icon so you never miss an update on silver, gold, and the evolving financial landscape. Until next time, stay informed, stay prepared, and stay invested.